Election years are notorious for causing fear and market volatility. In this video, we will guide you to protecting your retirement and keeping you disciplined for the upcoming 2024 election. Here are the top 3 things you need to get started. Number 1, you must have a comprehensive plan for your money in retirement. Whether it's an election year that has you spooked or some other event that is causing concern, could be Fed speak about interest rates, could be a geopolitical event, a war, an economic crisis like back in 2008. Creating a comprehensive plan is the number one thing a retiree can do to shield themselves during an election year. According to Fidelity, the U.S. stock market has performed well in election years. On average, the S&P 500 index has seen returns of around 9.1% during an election year since the year 1950. Now, does that mean that a good year is guaranteed this year? No. Most people are skeptics, and the desire to plan for the what-if scenario is very, very real. So make sure you have a comprehensive plan and you can avoid some of the market volatility during an election year. Number 2, you must protect your financial capital. Now, what do I mean? A good plan will see that a retiree has their financial capital protected. Financial capital is the income that you need for retirement. This is how you live your life. You saved money for a reason. You've got it accumulated so that you can retire and live happy during retirement. Income is the foundation during your retirement. So to protect your financial capital means that you must focus on investments that are conservative and create income. Great way for you to go here is to segregate your assets into 3 different buckets. First, bucket number 1, how much do you need to invest with the primary goal of those investments being income generation? Think about your shortfall here. If Social Securities and pensions are not going to be enough for you to live your retirement life, how much more income on a monthly basis will your portfolio and your investments need to produce? The money you put in bucket number 1 should focus on the primary goal of income production for you to supplement your cash flow. Bucket number 2 now should be how much do you need to invest for liquidity and growth, and then the potential for inflation adjustments to your income bucket. So if you're lucky enough to have enough money to where you have money stored in bucket number 1 that will take care of your income needs throughout retirement, and now you can put some money into bucket number 2, here's where you can focus on your growth. This is where you can focus on stocks and equities and more risk association with your investment structure. You can focus on how do I make the most? How do I be diversified? All those normal things that you're used to when choosing an investment strategy. But you should focus on these buckets with an eye to the future. That eye to the future means let's grow it while we don't need it. But if there comes a day in the future where I do need it, I can take money from this bucket, put it into bucket number 1 so that I can make those appropriate adjustments when that income that's being generated from bucket number 1 just isn't quite enough anymore. And finally, if you're lucky enough to have money left over after you've funded bucket number 1 and bucket number 2, you can focus on bucket number 3, which is legacy driven. I meet a lot of people today that tell me, Jarrett, if I have enough money left over when it's all said and done, when my wife and I or my husband and I have lived our final day on this earth, I'd love to be able to leave a legacy to my children and or my grandchildren. Well, here's where you can get really creative and you can develop a lot of unique strategy with regards to the types of investments that you use in your legacy bucket and how those can leave a more tax advantageous result for your family, your kids, your grandchildren. Now on to number 3. Take a disciplined approach with buckets 2 and 3 from my previous example. Seems simple. You hear this all the time. Investment advisors say you must stay disciplined. You've got to think long term when it comes to your investments, especially with stock market investments. Well, once you define purpose using the 3 bucket approach that we talked about, discipline on bucket 2 and 3 comes a little bit easier. Think about this. What is retirement all about? It's about being able to spend when you want to, how you want to, without worry that you're going to run out of money someday. So a lot of people think about it wrong. They think about, I have to save enough money to make it through retirement. No, you have to have enough money to develop an income bucket that you can't outlive. And there's a lot of different ways to do that. But if you're one of those lucky people who have enough money in bucket number 1, and you choose to be more aggressive with buckets 2 and 3, which makes sense, you have to stay disciplined. We know that markets go up and they go down. I have no idea what the market is going to do in this election year. We could see massive growth, we could see a decline, we could see a seesaw type of activity like we've seen in prior years. The key here is that you stay disciplined to that approach, because you know you shouldn't need to take withdrawals from bucket 2 or 3 if you've got bucket 1 set up. So let's recap. Number 1, build a comprehensive plan for your retirement. Number 2, protect your financial capital. That's the portion of your portfolio that you need for income during retirement. And number 3, stay disciplined on investment strategy and allocation, since you have buckets 2 and 3 set up for that purpose. Thanks for joining us, and we'll see you next week.